Welcome to the EY NextWave Private Equity podcast, where industry leaders come together to discuss emerging opportunities and industry trends shaping the global private equity landscape.
And then we said for every 1% additional allocation that they add to the private markets, it's $130 billion. So just think of the scale of opportunity.
That's Jenny Johnson, CEO of Franklin Templeton, one of the world's largest asset managers. I'm Bridget Walsh, EY's Global Head of Private Equity. In this episode, Jenny will be sharing her global perspectives on the future of the industry. Hi, Jenny. Welcome to the podcast. Great to have you here today.
Well, thanks for having me, Bridget.
Jenny, Franklin Templeton has a fantastic heritage in the asset management space that actually tracks the evolution of the industry pretty well. You know, when you look at the firm's move from brokerage to mutual funds and more recently to alternatives, maybe you can share with us the inside view on what drove those changes over time.
Yeah, I mean, I think the market drives the changes. Last year, we celebrated 75 years as a firm.
Wow. Congratulations.
Thank you. And, you know, you don't thrive over 75 years if you're not evolving with the industry. And so I think those trends that you talked about going from, you know, originally brokerage where essentially the advisor was paid in the mutual fund vehicle. And over time, I think in 2008, there was a lot of pressure from regulators to create more transparency around how people were paid. I think that's a good thing. That ended up with much more fee-based advisors. And then, of course, alternatives. It's just, you know, we looked at the trend. Companies aren't going public as early as they used to be, and banks aren't lending in the same way. And so you created private credit, and we just felt like we needed to have those capabilities as a firm.
Yeah, and it's a trend we're seeing amongst a lot of the large multi-asset managers as well, which actually has proved to be great foresight in the current market.
For sure.
You know, when the traditional leverage routes have dried up, you've probably seen the same with your private credit business.
Oh, definitely. No question. I mean, you know, you always question kind of valuations. How is it that a public equivalent security is trading at a much lower than, say, an illiquid private? I think it's a combination of both. You know, in these tough markets, when people need liquidity, the only place you can get it is in your public markets. And so they probably get oversold versus their valuation. And the private markets are probably a little bit slower to mark down.
And your recent move into alternatives, what drove that, Jenny, more specifically?
Well, so we looked at it, you know, you have half the number of public equity companies that you had in 2000. You have something like 5 or 6 times the number of private equity-backed companies. And so just to put that in perspective, there were about 6,600 public companies. Half of that, there were about 1,700 private companies. They're now private equity-backed companies, and they're now something like 11 or 12,000, right? So from an investable universe, we couldn't be completely excluded from the private equity market. And then in the case of private credit, you see, you know, you had these regulations, Basel III in Europe and Dodd-Frank in the U.S., and they changed kind of the capital requirements for banks. And so banks are just not lending in the same way. So you've created this real proliferation of private credit managers, and we have $82 billion in private credit. So in looking at it, we just felt like to be able to offer our clients the full spectrum of capabilities, we really needed to be in the private markets and the alternative markets. And you see it with the institutional flows that have gone there. You know, pension funds are anywhere from 20 to 35% of their portfolios, and some are even talking about increasing that. And then in the retail space, that number is very low, probably less than 5% of portfolios, but with a real desire to see more. So, you know, it's about evolving with where the market's going.
And I suppose part of that evolution as well, Jenny, is into the secondaries market. And my last podcast was with Mark Benedetti from Ardian. It was fascinating when we talk about that market. I mean, what a market within a market in private equity. You know, a market that was 5 to 10 billion a decade ago is now roughly 100 billion. And I see that trajectory going a lot more.
I couldn't agree more. I think that the time right now for secondary is an unbelievable time. And put that in perspective, there's been about $6 trillion deployed in private equity. And you mentioned 100. I'd say there, you know, probably now there's been 110, 120 billion deployed in secondary PE, with maybe another 100 billion raised. So 6 trillion to a couple $100 billion. And in markets like this in 2022, if you're a pension fund, you may have seen on average, the equity portfolio was down 22%. Your fixed income portfolio was down 15%. You needed to pay your pensioners. So you were going to your liquid assets and pulling those out, which was driving that down to even a lower percentage of your portfolio. And, I'll give you a real transaction. We own Lexington Partners, which is about a $65 billion secondary PE firm. One of the state pension funds call them and say, hey, we need $1 billion off our portfolio in 30 days. Can you come in and do that? And, why is that? Well, it's because those liquid assets have been driven so far down as a percentage that they're now over allocated to their private markets.
The denominator effect, really.
And they get quarterly check-ins, right? And so, at that quarter, they need those assets off the books. Lexington Partners comes in and they'll say, I want this vintage of this manager, this vintage of this manager. And they can take into consideration both valuations as well as the current interest rate environment, which is really important. And they buy those assets at a discount. And they'll tell you that these are some of the best discounts they've ever seen in their career. So big fan of secondaries. There's no J curve. You get a diversified portfolio. So I think it's a really great asset class to have. And we're really excited with what we acquired.
I share your excitement about this market. I think there's a lot more for us to see here. And I'm sure you'll be doing a lot more in that space, Jenny.
Yeah, no, because they're private equity, but we're talking about secondary PE and secondary private credit. I mean, any of these private asset classes can have a secondary market in it.
You mentioned Lexington. You've been so acquisitive, Alcentra, Lexington, and many others. From my own business, I know the skill it takes to embed acquisitions of people businesses. I've heard you speak about the balance needed between retaining those great brands, but also getting the synergies from the back office and distribution. Maybe you can elaborate on how you've managed to deliver this.
Yes. So our first really big acquisition, well, we acquired Benefit Street Partners, which at the time was about a $26 billion private credit manager. They're now about $40 billion. And that was in 2018. And then we acquired Legg Mason. And Legg Mason, which was traditional managers, with the exception of Clarion Partners, which is a real estate manager. They were one of the firms with Legg Mason. We were essentially acquiring 8 independent investment teams. Martin Currie, folks in the UK know them well.
Yeah.
Brandywine, Clearbridge. And so, we had confidence that we could make it work because we had acquired Templeton back in 1992 and have always had the philosophy in the asset management business that what are you doing when you're acquiring an asset management company? You're acquiring investment talent and their investment process. So the quickest way to destroy value is actually go in and mess with it. So we've been very comfortable leaving those teams independent and all of the supporting capabilities. So, one of our investment teams will say, it's really important that my traders sit on the desk with me, and we put traders on the desk. Others will say, I prefer to have the trades executed in the local market, so we have a global trading system. So they'll leverage the centralized trading. So the CIO and the investment team gets to define what is part of that process. We leave it independent. We have a lot of debates about how many brands we should have. We'll probably still have those debates. But on the traditional business, there's a lot of integration that happens in the back office. However, on alternatives, there actually is very little. It's really at the distribution because, take a private credit manager. They're doing a lot of their legal department are deal type of lawyers, as opposed to a traditional asset manager, which might be 40 Act and UCIT type lawyers. So you tend to leave the supporting team around and the technology and everything alone in the alternatives managers. So there's actually a lot less integration. And then the key, as I said, is around distribution and making sure you're delivering to clients kind of the full firm and really being efficient and effective at how you service those clients.
I love your point about don't go in and mess with it because you're retaining the culture that you have, which is effectively what you're buying.
Yeah. And I always say, the investment banker will tell you why it's a great price and why it's a great strategic fit. They never talk about culture. And I think the most important driver about whether or not a deal is going to work is if the two cultures can come together. And so we spend a lot of time with the people before an acquisition to make sure that it's a good cultural fit.
Jenny, private equity are great at investing and raising capital from institutional investors, as you know, but less experienced in managing large-scale distribution platforms, which Franklin Templeton does very well. I think that puts you in a really interesting position. How do you see that evolving?
So I think that's true. We know, you definitely have a big move by the large alternatives managers to try to, move into the wealth space. And there's only been a few of them that have really figured it out. Having said that, it's one of my top 3 priorities, and it's difficult. It's difficult because not only do you have to get your product in the right vehicle, which is different because these are, really illiquid vehicles, and there are not a lot of people in the retail channel that can, withstand 10 years of locked up assets. So you do things like interval funds. You have to do a lot of education and obviously convince the gatekeepers and firms. And then you have to educate. You have to help that firm educate their sales force on how it makes sense to fit in, how some private asset can fit into a broader portfolio. And, many of the large alternatives managers are used to walking into a pension fund and it's a one sale. You're either in or out. Here, maybe you get a financial advisor who says, yeah, I think this is great. I can see how it fits in my portfolio. But then that financial advisor, it's the tip of the spear that becomes the really complicated part. They have to decide which of their clients can actually withstand that illiquidity nature of the vehicle and to make sure that it's suitable for those clients. So it's an individual decision at every client for that advisor to make. So it's just a lot more complicated. It takes longer. There's smaller tickets. But I also feel like we're at a bit of a crossroads. I say, my grandfather got into the mutual fund business because the average person couldn't get the upside return in the equity markets until somebody came up with this idea of a pooled investment vehicle where you can get diversification, expert management for a reasonable price and liquidity. Yeah. We're at that same crossroads today in private markets because there are excess returns because companies are waiting so long to go public. You're seeing higher returns by the good private equity managers. Yeah. And right now we're leaving out the average consumer. I think, retirement plans are a great place for it. But again, we have to have the right vehicle and we have to make sure it's a suitable investment for the end client.
And accessing those retail investors is the real opportunity, isn't there? When you look at the scale of money sitting with private investors, yeah. I mean, it's astronomical.
Well, I think we did a calculation. This was based in the U.S., but we looked at the 4 largest distributors, and we said and I think that on average they're about 5% allocation, and we said for every 1% additional allocation that they add to the private markets, it's $130 billion, right? So just think of the scale of opportunity.
In that vein, I've heard you speak passionately about technology, tokenization, blockchain, and using that to more effectively reach those retail consumers.
The technology, because it's so efficient, you're going to start to see 2 things. One is it's going to allow us, because it drives down the cost of a transaction, it's going to allow us to fractionalize a lot of those illiquid assets and create liquidity in there.
Which I think is going to be the trigger event in private equity, Jenny.
Definitely going to be important. And then the second thing is, if you think about what blockchain does, is it does 3 things. It allows a payment mechanism. Right now everybody goes, yeah, but it's not dollars. But over time, that will fix itself. Number 2, it has the ability to create smart contracts, and I'll talk about why that's important in a second. And 3, it's a general ledger. So the general ledger component is when the transaction settles, it means you don't have this batch system and wait overnight. The New York Stock Exchange, closes at 4. You don't have to do that.
It's instantaneous.
It's instantaneous. There's no latency. And so you can imagine a 24/7 clock. Whether that's good or not is another thing, but you can imagine that because technology enables it. So here's an example of where you take those 3 things to unlock kind of a unique asset. Rihanna, the singer, she was performing at the halftime of the Super Bowl, the U.S. largest watch sporting event. And she issued right before it 300 NFTs, non-fungible tokens. They cost $210, and each of them basically had the rights to the royalty of one of her songs and it was 0.0033% right to a song. So how can she do that? Well, she can do that because the token can get embedded through the smart contract in places like Spotify and Apple Music. So when her song is played, there are no intermediaries that need to go settle that transaction. So you have confidence that when you hold that token, you're going to get paid. In addition to that, she has the benefit of probably making more in the economics because who's buying it? It's the Rihanna fans, right? So there's probably the economic value of the token, but then the cultural value, the excitement. Yeah. Now, you can imagine the same thing can happen with sporting athletes. You get a baseball player or an NBA star, who signs a couple $100 million contract and says, hey, I'm going to sell it off to my fans, 10% of it off to my fans. How much would somebody pay for a premium to be able to own a piece of their favorite athlete's, revenue stream and income stream? And for the athlete, they get a portion of that money right up front. So I think the key is that because it takes a lot of the friction out of a transaction, you're going to start to see new types of investments that are unlocked. And then old types where I think it's a Four Seasons or a St. Regis in Aspen, Colorado that's been tokenized. And so if you own a piece of it, the smart contract can pay you your share of whatever the profits are. But when you check in, they say, oh, you're an owner. Let me upgrade your room. So it combines kind of the loyalty with the investment. And I just think it's going to be really interesting to see how this all unfolds. Now, Franklin Templeton has a regulated money market fund. We worked really hard with the SEC to get approval on it. We're big believers that this should be regulated, and it will drive much of the back office in financial services firms. It's going to take some time to do that. But we believe that this market will be regulated, and it'll be really interesting to see the kind of creativity that comes out of it.
If you were to predict sort of a time horizon when we'll really start to see this coming to fruition, Jenny, what would you say?
So it's really hard to know that because one is I do think regulation is going to be a big component about whether or not the pace of that change. So that's one. And I do think that there are, Hong Kong regulators are very focused on this. The UAE is focused on this. Singapore is focused a lot and are moving probably faster than, say, developed market regulators. So I think in those markets, you'll start to see more of a convergence of traditional asset management and the blockchain and tokenization. But you also, every big financial institution is probably experimenting with parts of their business in their back office. Like when we did the money market fund, we built a transfer agency, a shareholder servicing system in blockchain. We were astonished by how efficient it is. So I think there are a lot of those types of projects going on. And what will happen is over time, they'll start to link up with each other. It's a classic hockey stick where everybody's sort of stumbling along and then suddenly things are going to link together and you're going to shoot up and people are going to say, how did that happen so quickly? And yet it'll have been years in the making.
Exactly.
It'll just hit that moment.
You just need that inflection point, don't you? I love your passion around this. And, I hear you're speaking at Consensus, sort of the world's largest crypto conference. How did that come about, Jenny?
I spoke at another crypto conference and they said, you got to come to Consensus. So, no, I think, I'm fortunate that at Franklin Templeton, we have a real team of folks that are very, very passionate on digital assets. And so I mentioned the money market fund. We also do node validation. We have active strategies where we recommend coins. Our team that does research on this does this thorough research. If you read a research report, it'd be as thorough as any fixed income or equity write-up that you'd see from our traditional analysts. We have a venture capital fund. So, it's a space that we think is important. For me, I'm third generation at Franklin Templeton, and I say what's my big fear is that, some technological disruption happens and we miss kind of the key moment. And so it's always keeping one eye on things that could be disruptive. And I think this is a space that's going to be hugely disruptive.
Jenny, you have a great global perspective. You've been traveling a lot. I know you've been in the Middle East recently. You obviously know the US market. And just any observations from what you're seeing out there at the moment?
I went with my executive committee to the Middle East. And actually, my executive committee is made up of some they're all world travelers, and several of them are emerging market investors. And one of the comments about Saudi Arabia is that they had never seen, because many of them hadn't been there since pre-COVID, they have never seen a society shift so much with what's going on. Women driving, but not just women driving. We would meet with pension funds and customers, and you had women in the CEO position. So, I think that was pretty fascinating. And I think unlocking that talent there, you're going to see tremendous growth there. I think a lot of the innovation that's going on, you're going to see some real innovation around green energy. Many people think, the fossil fuel companies, they're going to be protecting themselves, but they also want to make it over the long run. And so they recognize the change. And so I think that the focus on innovation there is pretty interesting. I think Hong Kong is really positioning itself as the gateway to China, and it's opened up a lot. It was interesting to see that. Japan is, talking about inflation. Japan hasn't had inflation in 20 years, right? Like, it's amazing to start hearing about those types of things.
And we're actually seeing, the de-conglomeratization actually starting to happen. Private equity really coming in. Huge amount of activity in Japan.
Yes, definitely.
Sometimes I come back from my travels and draw a spider diagram. I'll have a sovereign wealth fund investing directly and co-investing with another GP, investing in the GP. It's a very small world at the same time in our industry.
There's no question that we are very interconnected as a world, despite a lot of the rhetoric. I always say China and the U.S. need each other. So, and as you travel around, you realize how interconnected we all are.
Thank you so much. This has been a fantastic discussion.
Well, thanks, Bridget, for having me here. This has been great.
That's it for this podcast. But please do subscribe for more insights from the PE industry's top professionals. From me, Bridget Walsh, and Jenny Johnson, thank you for listening and goodbye.
Thanks for joining the EY NextWave Private Equity Podcast. For more insights and perspectives, visit ey.com/private equity.